Harshad, thanks very much for joining in. Good to have you with us here. I guess the big bet that you're making is that investors will come back to equity in a big way, right? Though daily mutual fund figures, which are reported as are negative, but at some point they'll make a comeback. That's the big bet. That's the premise.
Yes, absolutely. You're right that, I believe that the gross inflows have started to accelerate, but there is still redemption pressure. But I think, with time, we believe that the net negative will turn into a net positive. And you're absolutely right. I don't think they will come in a rush. The process will be gradual. But I think that is great. That's, great initial conditions to have for markets to do well from here.
The other one, Harshad, is the fact that this bull market, this bullish market will continue, right, for years to come. That's the other premise on which you're sort of launching this fund. The market is already 20% on top of the Dan 2008 high, but you believe there is a lot more to go. And there's a bull market here. Would you agree with that?
Yeah, I believe that, one is everybody looks to, typically focuses on the level of the index. I think that's very misleading. If you look at right now, the market may be at its all-time high, but on valuations, it is not at its all-time high. The valuations of the market based on street consensus estimate is about 15.1. That's, just above the long-term trading average. So there are, if you look at the two components of equity market returns or two drivers of returns, one is EPS growth. And I believe that over the next 3 to 4 years, you are going to have acceleration in earnings growth compared to last 4-5 years. And you have valuations which are, just above the long-term trading average. I think the markets could easily re-rate from here, maybe 1, maybe 2 standard deviations above. So if you go by the long-term returns on a compounded basis of 16 to 17%, I would believe that over the next 2-3 years, you should have returns significantly better than that from equities.
So what kind of expansion are we likely to see? Because we've seen a considerable amount of PE, multiple expansion. Now will the market, in your view, consolidate? Is that what we're seeing right now, the sideways market? Or do you think, the multiple expansion has still a lot of room to go? And earnings eventually will come, but the market will keep rising?
You're right in saying that that's how typically it starts, that the market returns will be driven first by valuation re-rating. But I don't agree, with your observation that it's done. It's not done according to me, because if you look at 15.1 versus 14.6 is the average, it's just above the average. We have seen in the past that, when things are positive in terms of economic growth, in terms of corporate sentiment, in terms of overall business sentiment, it could easily re-rate to 1 to 2 standard deviations above the mean. I'm not saying that you should bet on that, but that has happened in the past and that could happen now. As far as earnings growth is concerned, if you look at the current earnings estimates, the next 2-3 years, the forecast is somewhere in mid-teens in terms of earnings growth. And that is coming after a long period of below 10% growth, almost 4 years of sub 10% growth. So there is a base effect here. So I would believe that, yes, first leg of the rally will happen because of valuation re-rating, but you will also see earning upgrades to start. If you look at it from a top-down perspective, corporate profit pool GDP, it is at its almost all-time low of about 4.2 times. The average is 5.6 times. So if you assume that it goes back to 5.6 times by FY18, you on a top-down perspective, you have 22% growth in earnings, whereas currently analysts are forecasting somewhere in the region of mid-teens. So there is a lot of potential of earning upgrades. So I think this rally will be driven both by earning upgrades and also by valuation re-rating.
So what is your expectation in terms of earnings, say for fiscal 16, actually 15, 16 and 17? What's your roadmap? Can we go back to say 22, 25% of earnings growth?
I think eventually we will head there. So, the exit, rate possibly in FY16 could be of that order. That's not what is there in the analyst numbers. But, if this government delivers, there are lots of expectations from this government. So on key areas, if they actually, I won't even say exceed expectations, meet the expectations, then I will not be surprised to see 20% kind of earnings growth by the end of FY16.
I just want a specific answer to how will this earnings expansion come? Like what will lead it? Will it be demand revival? Because demand has to revive, right? Consumer demand, urban demand has to revive. And how, if that is the premise, how will it happen? Because then you're saying, well, the government will need to spend. Is there room for the government to spend? What are your thoughts?
Sure. So, let's first look at on the consumer side. If you look at the car demand over the last 3-4 years has been fairly stagnant, almost zero to a little negative. So car market in this country hasn't grown for the last 3 years. If you go back in history to see what happens to demand when it comes back, it never comes back. So after stagnant demand for 3 years, when the demand revives, it never revives to 5% or 10%. It revives to 15, 20, 25%. That is because of the latent demand that was postponed. Because, there is a lot of element of sentiment when it comes to demand for durables and of course demand for capital goods from the industry's perspective. So I think improvement in sentiment is an important factor for revival of demand for consumer durables. On the industry side, you will see business sentiment also improving a lot. Of course, they will wait to see what the government does on the ground. But when the corporate sentiment improves, many of the projects that were shelved earlier, I think they will come back. For that to happen, we should give time. I don't think it is going to happen in the first quarter or second quarter. It is probably an FY16 story, but the announcements will probably start coming in the second half of this year. Also, as you know, there is a lot of fixed asset investment that has happened into India, which is not yielding output. A lot of stranded assets, power assets and so on. I think the first leg of growth will probably come from those assets being put to work. So the hurdles being removed from those assets and those assets starting to generate output. I think the first leg of growth will probably come from there.
Right. To focus, so you're saying consumer demand depends on animal spirits and sentiment. Well, that's already starting to pick up, and I think in a quarter, 2 quarters, we'll see demand for consumer goods, consumer durables. But for projects, you're saying it'll take longer. It depends on animal spirits, clearances of truck projects, and asset productivity as well. That has to pick up.
That will be the first leg, and subsequently it has to be followed by corporate investment again picking up. I think that will happen, but it will not happen in the next few quarters.
But Harshad, you're not betting on a new capex cycle, right? You're betting on revival of the dead one, the existing one.
No, so what I'm saying is that in the first phase, the focus will be on stranded assets being taken care of and those starting to generate. So there are lots of power plants which are built but not generating electricity. I'm just giving it as an example. So the first focus of this government, I guess, will be on sorting those problems out. And when that happens, I think subsequently new investments can be attracted.
Harshad, do you think expectations from the new government, both from the financial market and corporate India, are running very high, way higher than what is expected? What can be reasonably expected?
I think expectations are high, but good thing is that I don't think they're reflected in the stock prices. Because even after this, if the valuations of Sensex is only at 15.1 times, I don't think these are euphoric conditions. Look at the flows. Domestic flows on a net basis are still negative. So people are feeling positive about it, but I don't think they have acted on it.
You also have, just to sort of, come back to your business and your funds, you also have a mid-cap and small-cap fund. I'm sure that's done very well. Right, Harshad?
So mid-cap category has also done well. In fact, if you look at year-to-date and compare Sensex returns versus CNX mid-cap returns, CNX mid-cap, which I'm using here as a proxy for mid-caps, has outperformed large caps by 9.5 to 10%. Right? So I think that part of I'm not necessarily saying it's done, but if you compare large cap returns with mid cap returns over long term on a CAGR basis, mid caps have delivered better returns to the extent of about 2 to 3%, whereas year to date they have outperformed by 10%.
Harshad, the small cap index, I mean, if you go back to the last bull market, say 2003, actually starting 2004 in right earnest to all the way to about 2008 high, the small cap index went up 10 times. I think the Nifty went up 5 or 6 times or so. If we are in a bull market, I know, I mean, history doesn't repeat, but it sure does rhyme. Do you think we can see something similar? The mid-cap and small-cap part of the market doing phenomenally well, outperforming the Nifty by a large margin?
Yeah, it's very hard to say whether the differential will be that much or not. What we can say for sure is that equity as a category is going to do well. It's very difficult to time because there are always phases when large caps do well and mid caps do well. Also, do not forget that mid caps also come with a lot of volatility along the way. So it really depends, from an investor perspective, he really has to ask himself as to what is my risk appetite. So when I'm allocating money to equities, do I have adequate exposure to large caps? If that person has an adequate exposure to large caps, then adding a mid cap fund might make sense. But to start with, if you have zero exposure to equities, our belief is that it's always prudent to start with large caps.
In your new fund, and I mean, I just want to ask you about your style of picking stocks. I mean, what are you following? Are you looking for growth stocks here with the hopes of recovery being very strong? Are you looking at value names? I mean, just to sort of give our viewers an idea about what are you focusing on when you go about picking stocks for your funds?
Yeah, I will tell you how the portfolio of our existing funds are positioned, and we have been positioning that way for last 6 to 8 months. So we are positioned for a cyclical recovery in the economy. Even before the election outcome was known, we have been positioning our portfolio that way, because if you look at the GDP growth, I think most people were expecting growth to pick up from FY15 even before the elections, right? So if you look at sectorally, we are very overweight on financials, we are overweight on industrial and infrastructure sectors, and we are overweight on cement. Whereas in terms of underweights, our key underweights are consumers, pharmaceuticals, and IT services companies. Not because there is a problem with that sector, it's just that we believe that in a cyclical upturn, these 3 sectors might underperform.
And you plan to sort of keep the same kind of weightages in your new fund as well, the top 100?
We will after 16th, we'll probably, we have been adding to that. Adding to the cyclicality.
I just want to sort of wrap out with one last question on financially leveraged companies where the business model was not bad, but managements got very exuberant as in the last bull market, took on a lot of debt, expanded where they did not need to, diversified and things like that. But the core business wasn't bad. Now, of course, they'll be able to raise, as stock prices look up, they'll be able to raise money to repay some of that debt, delever essentially. Should one focus on those kind of names as well? What's your view?
No, I think one cannot really make a generic statement. You have to really look at it on a case-by-case basis, which is what we try to do on a bottom-up stock picking. But your observation is absolutely right, and that's exactly what happened in 2009. When equity markets do well, many of these highly leveraged companies manage to raise equity and deleverage. So I think that is likely to happen this time round.
Got that. Harshad, it's a pleasure to have you with us here. Thanks very much for your time.